I will begin with a brief introduction. Hello, everyone. Thank you for joining us. Today, we will talk about financial modeling, how to build models that are not only technically correct, but also are practical tools for analysis, discussion, and investment decisions. And our webinar today consists of two parts. First, we will discuss the general principles and best practice of financial modeling, what makes a model transparent, reliable, and useful for decision making. And then in the second part, we will show how these ideas can be implemented in practice using specialized tools. Let me introduce our speakers. Our first speaker today is Varun, who will talk about the principles of effective financial modeling. Varun is a strategic and finance advisor at IIM Skills. This is one of the leading providers of professional financial training programs. And after Varun's presentation, the second part of the webinar will focus on practical implementation. I will present AltInvestX, a tool that designed to help analysts and businesses create professional financial models faster and with fewer errors. Our company, I will introduce the company right now before we start our presentations. Our company is a strategic consulting. We have 30 years of experience in this area. We specialize in long-term planning. Financial models are usually the final and the central document in our communications with clients. And it's no surprise that we always try to standardize and automate the modeling. As a result, in addition to our consulting business today, we have more than 3,000 corporate clients who create their financial models with our applications. And today, I will show you the newest one in this family of products. So before we start with the presentations, let me invite Shiva Srivastava, Head of Sales and Business Growth at IIM Skills, to introduce their company. Shiva, please, the floor is yours.
Thank you so much, Mr. Dimitri. Good evening, everybody. This is Shiva Srivastava. And let me give a brief introduction of the company, and that's IIM Skills. So IIM Skills got started in the year of 2015. And in today's time, IIM Skills is one of the world's leading online education providers. IIM Skills is working into multiple verticals. I mean, there are different type of training programs, courses that IIM Skills is offering. These are the skill development based training programs. For an example, IIM Skills mainly is dealing with finance and accounting domain, digital marketing domain, analytics domain like data analytics or data science, and even into the writing domains. The headquarters of IIM Skills is in New Delhi, India, and it's been more than a decade since IIM Skills is bridging the gap where people are actually having some sort of aspiration and they're looking to achieve some sort of goals. And with the help of the training programs of IIM Skills, we are fulfilling their needs. So without taking much of the time, I would like to invite Mr. Varun, who is the strategic advisor at IIM Skills, if he can come ahead and take over the session from here.
Thank you so much, Shiva, and thank you, Dimitri, for the warm introduction. And welcome, everyone. Welcome to the financial modeling webinar. I'm sure this is going to be fun, and let's get started into this. So this is what all we will cover. We'll talk about what exactly is a financial model, what are the applications of financial model, what are the different types of financial model, and how do we use financial models in our day-to-day life, how a businessman would use it, how a corporate would use it, how an investment banker would use it. So different people have different aspirations, different use cases, and everyone is going to use the same tool, but in a different fashion. So we'll talk about all of that. So before we venture into anything, let's first understand what exactly is a financial model. So whenever someone asks you this question, or whenever you have to tell everything, the first word, the first keyword that should come into your mind should be a tool or a calculator. Like we all use a calculator in our mobile phone. We use it in a very unconventional way. That, hey, let's figure out what is the mathematics of A plus B minus D plus C minus F plus G multiplied by H, whatever. So that calculator is going to solve a purpose that you input certain numbers and it will give you an output. So it acts as a bridge. So basically, you input certain characters, certain numericals, and give it a command, and the calculator processes them and then gives you an output. That output is a mathematical number. Similarly, financial model is designed using different softwares and spreadsheets. MS Excel is very common. These days, we have a lot of technology that Dimitri would cover. But the nuance of financial modeling is that it has to be placed here in the entire value chain. So this is your financial model. It has to be built in a way that can feed financial statements, assumptions about the future growth, assumptions about the working capital, and give you an output. That output could be the projected financial statements. It could be a valuation number. It could be an IRR on an investment. There can be different things. It could be used for risk management. And different people would have different reasons to use a financial model. So this takes me to this particular slide, decision support. Let's hypothetically assume that there is a use case wherein there is a business person who is confused whether I should take a particular property on lease or I should buy it. Now, there would be different costs and different benefits associated to it. We have to do a cost benefit analysis. That would be done through a financial model. What will be the impact on the profitability? What will be the impact on different items in the P&L? Whether you can charge the depreciation, what would be the interest if you have to take a loan and all that stuff, the tax benefit. Let's take another scenario. We are evaluating a business wherein we have to invest money. Now we need to understand that what is the future predictions for that particular business. Will they be in a position to service our investments? If we are giving them a loan, would they be able to pay us interest in a timely fashion or not? If we are giving them equity, what would be the growth in the equity? Will we be getting benefited in next 3 years or 5 years or 10 years? So that clarity about the investment and returns comes through financial models. Now talking about the risk visibility. When we talk about risk, there is plenty of risk when we are dealing with businesses. It's not always about that, hey, the product would be manufactured correctly or not, the customer will pay or not. There are much bigger risks that are macroeconomic. They're related to the things that are actually not in your control, but would definitely affect your business and your returns. Interest rates, foreign exchange, inflation. And in today's economy, as we see in today's scenario, there are wars happening across the globe. Different countries are targeting different nations. And because of that, economies of a lot of other businesses is also getting impacted. Because in today's economy, we are a global village. So understanding that, capturing that effect in financial models so that you can take a better decision is an art. And that art is achieved through, again, financial modeling. Then operational alignment. This is a lot common in FP&A, that is financial planning and analysis. Every CFO in a business, whether it's a small business, a medium enterprise, or a large conglomerate, they have a department called FP&A, which focuses on budgeting, variance analysis, understanding that what were their targets, were they achieved, if not, why not, all that analysis, so that their progress is maintained, recorded, and tracked. That is under operational alignment. Now, this takes me to the next slide. That is, what are the types of financial models? There are probably a few common types. One would be a three-statement model. Some people call it as projection model. Some people call it as forecast model. This is basically the basic version of the three-statement model, which can be converted into a forecasting, which can be converted into reforecast, which can be used as a budget model as well. So the next thing, that is valuation, DCF, comparable company analysis. There are different approaches to valuation, and every valuation is done through a financial model. But when you are, let's say, acquiring a company, you are doing mergers, acquisition, joint venture, you need to make another model. You need to understand if that is going to be a good opportunity or not a good opportunity. If you are doing it for internal things, you could be doing it like, hey, I want to analyze if I should launch a marketing campaign or not. Because if I launch a marketing campaign, I would incur a cost, but that would help me get more sales. So would that additional sales be sufficient to cover the expense and make a margin or not? So these type of planning is also done through financial model. So I've written a few of the common ones. Capital budgeting, as I mentioned. Where should I get the money? Where should I invest the money? What would be the plan? Project finance and valuation. This is very common in the economies that are growing, that have heavy expense on infrastructure. For example, Dubai, they use a lot of project financing because you need to understand that it's going to be a 20-year plan. So where would the money come from? What would be the cost? What would be the fixed cost? What would be the variable cost? And what would be the ROI? All that is done through project financing. M&A, as I mentioned, if you acquire a business, would that be an interesting thing or a dull thing? Technically, there are two terms that are associated to it: accretion and dilution. If it is a good thing, the shareholders will benefit. It is called accretion. If it's a bad thing that would reduce the income of the shareholders, it is called dilution. NPV/IRR analysis, what is going to be the worth of the investments that we'll make, the return on the investment. Then this is all FP&A, budgets, forecast, understanding the variation between budget and actual, department level P&L. There's a corporate level, then there are different departments. Maybe the corporate at the broader level is doing amazing, but there might be a few departments that require intervention, that require further scrutiny. And that is possible when you have FP&A models built on a department level. Then KPI dashboard. These Excel sheets are very technical. And the CEO of a company or the management of the company don't have time to actually look into the Excel formulas. They would need, hey, tell me the dashboard, show me the output, show me certain visuals so that I can understand and analyze if it's an upward trend, downward trend, what is increasing, what is falling, and all that stuff. Now, in terms of commercial or operational models, this is more related to the internal decision making, pricing, capacity planning, whether I should go and onboard more clients or whether I should focus on building capacity, whether I have capacity to increase the supply or I should first focus on doing marketing because I have that. So all these type of decisions are taken through the commercial and operational models. Right now, just to keep it easy, we'll focus on the most common ones, that's three-statement model coupled with a few analysis. There are certain things that are very common in the structure of a financial model. You can understand that financial model is just like a book. You do not directly get into the content of the book. There are certain things that are covered before and after the book. For main content, we start with a cover page. We talk about the index. Then we talk about the basic or the core part. Then we talk about the closing part. Similarly, in a financial model, there has to be certain settings that you have to create, certain things that need to set the tone of the financial model, and that would cover the cover page and index for the navigation purposes. You need to tell, hey man, I'm making a financial model for which company? What is the type of the model? Is it an LBO, M&A, or a valuation model? You need to tell what all sections are covered to an index. Then you need to tell that, hey, these are the assumptions that I'm making. I'm going to assume this is the inflation rate, this is the tax rate, this is going to be the next demand of the company, all that stuff. Then you need to also include the financial statements, historical of the company. You need to understand that, hey, my projections are based on this set of data. This is what I got, the customer data, the vendor data, all that stuff would come into this section. Then the drivers. This is going to be the microeconomic things. what is going to be the price, what is going to be the headcount, what is going to be the discount percentage I plan to give in the next 1 year on an average, all that stuff. Then would come the output, that is the financial statements. Once you have this, you can actually forecast the financial statements and do an analysis. This is the analytical output. If it's a valuation model, a DCF sheet, it's a fair. If it's a investment model, maybe an IRR calculation. So all those type of analysis would come into this section, plus some cookie points if you can add certain checks to ensure that a financial model is solid. It is not broken. For example, balance sheet is matching. For example, cash is not negative. These type of things are good to have. So this is how a structure of a financial model is created so that you can actually set up a model like a book, which has a starting point in terms of cover page, index, assumptions, financial statements, business driver, forecast, output, analysis, and checks. Moving to the next part, what are the core principles of the financial model? And we call it in our industry as TC-FAS. These are very important. See, financial modeling is a very responsible job because based on that particular analysis, that particular analytical data, the companies are going to take decisions, and that decisions would impact livelihood of the people in the company. That decision would impact the stock market. That decision would impact the broader economy. So it has to be an ethical thing. You cannot just randomly put assumptions because that's going to fail and would adversely impact the entire ecosystem. And sometimes, if it's a big company, entire economy as well. So the core principles that you need to follow is certain are technical in terms of the building of the financial model, and certain are in terms of sourcing the data. For example, transparency. Your data needs to have certain reasons. For example, if you are assuming X percentage of tax rate, then what is the source of this data? Maybe a government website, maybe a recent article, maybe the budget that came. You need to add that so that people can track and trust that this is a genuine input. You need to basically say that, hey, this data is coming from this particular resource and this is the reason. For example, if you say that, hey, I think that the percentage of discount that the company plans to give on a product A is going to be 3%, then how did you do it? You cannot randomly assume. Maybe through a transcript, through the management call, you can mention the source. Then consistency. If in a financial model, you are showing that revenue minus cost is equal to profit, or you want to show as revenue plus a negative cost is equal to profit, that structure, that articulation of the financial statement needs to be consistent. For example, you can show it as 100 minus 20 is equal to 80, or you can show it as 100 plus negative 20 is equal to 80. A negative number in accounting and finance is represented through a bracket. A very important fact. That consistency needs to be maintained. Then your financial model has to be dynamic, has to be flexible, because it has to take a lot of inputs. For example, you want to check what if my price changes from 10 to 12 rupee or dollar or whatever currency you're making. Then it should have that ability to actually play around with numbers. So that flexibility of the data should definitely be an option. Certain scenarios need to be built. The three common scenarios: management case, bear case, bull case, optimistic, aggressive, conservative. People use different nomenclature for that, but you need to make sure that it is a flexible model. Auditability. This is what I was saying when I said the checks tab in the last slide. You need to basically make a financial model that can be easily checked, because maybe the user of the financial model and the creator of the financial model are two different people. For example, Dimitri created a financial model and I have to use it. So I need to know that how to check if I am using it right. There has to be a manual around it. There is a specific tab that some financial modelers create that mentions the steps on how to use it. What are the logs? For example, it's a financial model that is going to be used repetitively. There should be a sheet of logs that, hey, I changed this assumption. Hey, I changed this. So that list of changes or edits can be maintained in that financial model. And last and the most important, simplicity. You don't have to overcomplicate it. You don't have to make it sound like you are making a financial model just to make it a lot complex. It has to be simple. It has to be something that the other person can actually use. So that's an important thing. Then coming to the mistakes. First, I'll take a pause. Anyone has any question? I'll take a 1 minute pause if anyone has any question, and else I'll move to the next part of mistakes. Okay, let's move to the next part. So there are a lot of common mistakes. As I said, that financial modeling is a very responsible thing. So we need to know what to do right, and we also need to know the don'ts. When people randomly input numbers, the model gets broken. For example, let's say that I have created a formula that x plus y is equal to z, and someone directly inputted 2 here instead of a input. It might break the formula. And next time when I'm checking, this number will not automatically get updated because it is not linked to any other cell and it's an input. And that might create a check error, and it might feel like ages to identify where the gap is if the person is not smart. So just to make sure that your financial model remains flexible and dynamic, you need to make sure that hard coding of the numbers is not allowed at every place. There are specific sections that are dedicated to these inputs or hard codes that are called assumption part or input part, but not in the calculation part. So you have to maintain that difference. Then sign convention. As I mentioned in the previous slide, you need to make sure that your sign convention is maintained. If you are showing the cost as a negative number, you should keep on showing it as it should not become a positive number with a minus sign. Then you have to maintain that uniformity and consistency across. Don't over engineer it, keep it simple. There is no benefit to show that you know fancy and extensive formulas if the other person is unable to understand it. Circular reference. This is very interesting. So this is something that people genuinely don't realize that they are making a mistake because their computer settings might be that it's enabled for iterative calculations. Now, let me explain what this is actually. For example, I'm saying that the price of the product has to be, let's say, 90% of my, or let's say, price of the product has to be 150% of the cost price. The selling price has to be 150% of the cost price. And my discount will be, let's say, 10% of my selling price. Now, this is a circle because my cost price is dependent on selling price is dependent on discount, and so on. So if I create a specific relationship wherein the 3 variables are interdependent, it will create a circular reference. Now, I have to make sure that my values are only one directional. If X is getting helping to calculate Y should not be an input for X. It should only go on. It can calculate Z, it can calculate A or B, but not X. So that circular reference should not be created. Now, creating scenarios and running sensitivities or creating cases in a very easy or layman language is very important. Your financial model is not something that you build and everyone would blindly follow. It has to have cases. It has to have scenarios wherein they want to play around with different assumptions. So that flexibility and that structure needs to be maintained. Next is balance sheet. I have seen people who create amazing financial model, but at the end of the day, they realize that balance sheet is not matching because they have missed linking certain items in the balance sheet with cash flow statement or with P&L. This is very important that your balance sheet is properly structured and properly linked. That is an important thing. Now coming to the options. There are 2 options. For example, you can create a financial model in a single spreadsheet with one section below the other and the other than the other. And in the second option is that you create a horizontal structure, you create a dedicated tab for all the different things that you're going to include. For example, the Power Page Index settings. For example, assumptions, revenue sheet, assumptions, financial statements, and the output. They can be in different sheets or they can be structured in a particular single sheet, but the print setup is very important. You need to make sure that they're clean And there is no right or wrong. Some people follow this, some people follow this. Both are right. It's just that you have to make sure they're clean and the print setup is done nicely. Now coming to the next part, fast. This is very similar to what I mentioned. I'm telling you different ways to look at financial model: flexible, appropriate, structured. It's nothing going to be additional that I will tell you here. You need to, on the bottom line, is that financial models have to be dynamic, clean, well structured, someone who can understand it perfectly fine. That's it. If you are able to make a financial model in that sense, perfect and great. Now, scenarios. Now, let's take a real world example that you are creating a financial model for your company, for your business, or maybe for a business that you want to invest money. So you are like, hey, let's assume they are going to do 100 units of sale at 10 rupees. I'm just taking basic assumption. So 1,000 rupee would be their revenue. Then they would be making, on an example, a 40% cost of goods sold, so 60% gross margin. This is not going to remain static. There might be scenarios wherein you are uncertain because you are talking about the future. You cannot, with 100% confidence, say that the price is going to be 100 or the unit is going to be 10. So you have to maintain that flexibility, and that is maintained through scenarios. As I mentioned, that there are different assumption cases that you can prepare. You can create a football field analysis chart. You can create a tornado chart. You can create different visuals to show that what if the case A happens, what if the case B happens, what if the case D happens or C happens, what is going to be the impact on the valuation, what is going to be the impact on the profit or return on investment. So that's basic structure. In a nutshell, financial model is a tool that is going to help you actually build something dynamic and take decisions. It can be used for valuing a company if you want to invest money. It can be used for understanding the business credibility and ability to pay off the debt. It can be used to track and build a hiring plan, marketing efforts, anything and everything that you would need. This is the checklist of what all I covered, and I would be happy to take up any questions that you would have. And this is just part of the intro. The next part would be held by Dimitri, wherein he'll talk about the applications and some practical tools to make financial models. But I'll take a pause, and in case you have any questions, I would be happy to answer them. Awesome. Cool, then I'll be around. I'll let Dimitri take it from here. And if you have any questions, I'll be around and you can ask. Thank you.
Okay, thank you, Varun.
Pleasure.
1 second. I will share my presentation. Okay. So, what we just discussed is the basic principles of financial modeling, and if you adhere to these principles, you can expect that your model will be clean, transparent, and reliable. But the reality is a bit harder because there are many challenges that people meet when they do financial modeling. And the first problem is that building a model when you work from scratch to create a structure of your financial model, you will need hours, sometimes days, and during the whole process, you will have to be accurate. You will have to think about your style, the style of your model, about every formula. So this takes time, and people always look for a way to make it easier. And another problem because of this time-consuming model setup process is that if you do it by hand, then you make mistakes. People always make mistakes. And by the way, if you going to rely in the future to artificial intelligence, then don't be very optimistic, because artificial intelligence make mistakes as well. So to avoid those mistakes, to come to a useful financial model, you will need enough experience, education, and that again takes time. And experience comes with even more time, more work. So that makes the process even more costly. And the most natural way to reduce these barriers is to have templates. But we have a problem with the templates because from one side, financial analysts expect that the model you present will be in some way standard, very well known for them. But at the same time, no template, no standard template fits all the projects. Every project has its own revenue stream, cost structure, financing features, and so on and so on. So there are many things that you will have to change in this standard template. And unfortunately, for a usual template, the time that you will spend customizing the template sometimes is even bigger than the time that you need to build this model from scratch. So to to do something with these problems, we introduced recently a new product, AltInvest X. What AltInvest X is? This is an Excel add-in that works together with you in your Excel and do all the boring work. It offers you a list of templates, customize them, add revenue or cost drivers, write all formulas, so that for 90% of the template, the models, you will not need to write anything yourself. You will just watch as this program creates the model for you. And the basic idea here is that the model has a list of customizable templates, and this Excel add-in can change the structure of those templates and can write all necessary formulas into these templates. Those templates cover such strategic financial planning tasks as project finance, business valuation, just long-term forecast for companies, venture capital, capital budgeting. So we have a lot of various templates. And the whole process will be completely automated. I will show it to you in very short time. Excuse me. What is the standard procedure with AltInvest X? The first step, we select a template that will be the basis of our financial model. At the time when you select the template, you also set basic parameters like number of periods, planning step, start date, name of this project or company, things like that. So when you open this template, when the add-in opens it for you, it's already customized for your project. Then you can populate these templates with all that necessary for your project, like products, costs, capital expenditure items, loans, leases, and so on, because the program has an internal library of all various formats that could be useful for these types of drivers. Then you just have a regular Excel model, and you just fill in the numbers, and you work with this model just as if you created it yourself and didn't use any program. You can send this model by, for example, by email to your colleague or your investor or your CEO, and they will open this model and work with that just as if you created this model yourself. And at any time, you can return to AltInvest X and again change something in the model, add new drivers, change time span, or whatever you need to change in the model. And again, you don't need to write any formula yourself. So this is the general idea of this product. And I will show you how it works in real life. 1 second. So this is just Excel without any template. This is how you start working with your financial modeling. After installation of AltInvest X, you have another section in your Excel ribbon called AltInvest X. Let's push create a model button. So we have a dialog when we can choose the name of our project. And for example, I need this model by quarters, starting from the next January for 5 years. And I also need additional sheet with reports by years to make it more comfortable when I present in this model. And I will use a new capital investment project template for this model. It will take several seconds. The app will configure this model for me. And what I have now, this is a standard, well-prepared financial model where we have various technical settings, currencies, tax rates, discounts, all that you need in any model like this. And then we have an empty sheet plan. I will return to this sheet later. Then we have a finance sheet with loans and equity, financial reports, all in standard international format, ready for investors and banks. As I said, the same report prepared by years, and you can see that all formulas are here. So the add-in created all formulas for you. And then on the analysis sheet, we have NPV calculation, IRR, things like that, DSCR, TD, EBITDA, all the ratios that are usually used in the investment project analysis. Okay, but this is an empty model. And now we go again to AltInvest X and choose items list. For example, I have two products, product 1 and product 2. And I would like to forecast their revenue. Sorry, product 2. I would like to forecast their revenue, for example, by planning unit sales and the price for those products. Okay, I added, and I can see that now I have these products here. All I need now is to enter the numbers. So all the formulas are prepared. They are linked to the reports. I have annual reports linked to the quarterly reports. So everything is okay, and I didn't spend a second to create this model. And the same way, I can do anything what I need for this model. For example, I have production expenses. Okay, maybe I have many of them. And that they will be just money. I don't need any other parameters. So I just want to create this structure in my model. Okay, now I jump to the production expenses, and I can see that my model now have all these expenses. They use inflation cost, everything. So this is the idea of AltInvest X. This program create all the structure for you, create all formulas, and it controls that your model is correct, that it doesn't have any error. So for most tasks like business valuation, project finance, investment project analysis, maybe financial model for a detailed project report, and other things similar to that, you will not need to do any formula editing. And without formula editing, you will avoid all possible errors. I can show you how this looks like when the model is filled. I'll open an example. Okay, for example, we have a plan for a composite gas cylinders plant. And for this plant, we have products, those cylinders. We have raw materials, all that was created by the program, production expenses, marketing expenses, personnel, and so on. The whole model was completely built by the program. I didn't fill anything by hand. And as a result, we have a complete financial model, and we can now use it in our presentation. So this is the idea of the product. And I will return to my presentation for a moment. Another interesting thing with this, one second. Another interesting thing with this application is that the set of templates used in the add-in and the set of formats for items for revenue or costs and so on, they are all customizable. So actually, based on this principle, you don't work within some style, within some fixed template. You can adjust this template for yourself, or for those who participate in today's webinar, we actually offer you a special service. If you're interested in this product, we can provide free consulting and customize your templates for your cases. And if you're interested in that, you can just send us any description of your case, and we will show you how this case can be managed within AltInvest X environment. So this is the last thing, and the very last thing is that if you need our presentation materials, we will send them in 1 or 2 days after the webinar. But the only thing, if you registered only in LinkedIn, then and you didn't register in Zoom, then we don't have your email. So for those cases, please use this QR code and join our WhatsApp group, where we can send you all necessary information. So that's it. And if you have any questions, I'm happy to answer to those questions. Okay, I see that no questions now. Then thank you very much for coming. As I said, we will try to send you all information from this webinar. So if you haven't registered for the webinar in Zoom, then please join our WhatsApp group, and we will send you this information via WhatsApp group. That's it. Again, thank you very much. Thanks to our partners, and bye-bye.
Thank you so much. Have a good day.